Most people are going to end up with a conventional or an FHA loan. There are a few differences. See, you already can tell my handwriting is horrible. There's a few differences between these programs, and we're not going to get into specific guidelines or specific details of each one. I want to give you a general overview of how they work. A big difference between the two is how they manage the risk if you don't put 20% down on the purchase of your home. So traditionally, lenders expected a 20% down payment. A lot of folks that we talk to don't have 20%, or if they do, they might not want to put it down, and we'll explain why when we get to that portion for you guys. And so they've come up with this alternative method called mortgage insurance, and we're abbreviating it with MI, mortgage insurance. On the conventional side, it's private mortgage insurance, meaning there's multiple companies out there that offer it. We'll shop around to make sure we get you the best one for your credit profile. Although they're very similar, sometimes there can be some nuances. So this is private side. FHA is a government insurance program. It's government insured. They actually call it a mortgage insurance premium to be a little bit different. So this is PMI, this is MIP. But for our purposes today, we're just going to refer to everything as MI, mortgage insurance. And it's on the government side of things. FHA really is an act of Congress to change. It's a federal program, and it's the rules were established by Congress. And FHA isn't a lender. They don't give any money, but they do offer an insurance policy for those that use that program. So we refer to them as FHA insured loans. On the conventional side, on the private side, a couple of distinctions here. This takes into account a tiering system. So it's based on credit and percent of down payment. What I mean by that is if you put 5% down, which is typically the minimum, although as first-time home buyers you could put 3% down, and again, we'll talk about that more specifically in your situation. But if you put 5% down and you've got excellent credit, you're going to pay a smaller monthly factor than someone who has 5% down with mediocre credit. They're going to pay more for the same loan because of their credit situation. It's a risk factor. If you put 5% down and you have excellent credit, and someone else puts 10% down and they have excellent credit, they will pay a lower mortgage insurance factor because of the fact that they're putting more money down. So not only are they paying less per month because they're borrowing less, they're paying even lower amount because the risk level is smaller. So this is tiered based upon credit and down payment. On the FHA side, there's a small variance, but for the most part, it doesn't really matter. If you qualify for an FHA loan, whether you have a 640 credit score or a 740 credit score, you're going to get very similar, if not the exact same terms. You put 5% down or 10% down, and you're not going to see a variance in the factor. You'll pay a little bit less if you put a larger down payment because the loan amount's smaller, but you're going to be paying the same factor regardless of your score. So someone that has a low down payment and mediocre credit, we tend to move them into the government side, okay, into the FHA side, because it doesn't negatively impact them if they've got mediocre credit. Because you guys have strong credit, it's going to be more likely that we move into the conventional side because the mortgage insurance is likely to be lower. But the other consideration with the mortgage insurance is how it's paid. So with the conventional side, it's paid monthly or upfront. Those are the typical ways, and most people do it monthly, meaning they make a small monthly payment in addition to their mortgage payment for this insurance, or you can pay a lump sum up front and not have that on a monthly basis. On the FHA side, you pay monthly and upfront. So it's actually two different premiums. On the FHA side, the upfront premium is not paid in cash at closing. That's an important distinction. It's added to your loan amount. So if your loan amount is $100,000 to purchase the home, you're actually going to be borrowing $101,750. then it's coming out of your equity. So you are paying for it over the life of the loan, but you're not paying for it at closing. And you pay a monthly premium. Another distinction is that conventional loan, the MI eventually goes away. If you have a lot of equity build up in your home after a couple of years, you can petition, you can ask your servicer, the servicers, the company collecting your payments, you can ask them to have it removed. And there's a process for that, and it's up to them whether they do or not, but they'll evaluate that opportunity, that decision. By law, it has to go away when you get to 78% of the original terms. So you buy your home for $100,000, when your loan amount's at $78,000, it has to go away by law. On the FHA side, it never goes away. You'll have it for as long as you have the loan. Now, that sounds horrible, and it is more expensive over the life of the loan, but the reality is most people refinance, they sell, they do something within that 5 to 7 year period. So either option is probably going to have like mortgage insurance for the life of the loan. But if this is a longer term solution for you, FHA could be a lot more costly because that insurance will never go away.